Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Peterson.
Thank you for joining the Real Estate Risk Report. I'm your host, as always, Lance Peterson. So once again, I have my friend with me, Ryan Parson with Mile Marker Club. Ryan is a frequent guest of the program. He is the one who pulls us out of the weeds and back into a more holistic view of our financial picture. So super happy and excited to have him with us today. How you doing, Ryan?
I'm doing great, Lance. Thank you very much for having me back. It's always a pleasure to be here with you and your audience.
Yeah, it's good to have you. We love having you. So, as always, things are really picking up steam here, with all the things we're doing over on the Verivest side. Before we hit record, Ryan and I were talking about that. One of the things that we've done with Verivest and with this podcast as well is, right, we're really trying to foster a conversation. And like I tell most people that I speak with, when I woke up this morning, as far as I'm concerned, I'm the leader of a movement, a humble leader, one who, isn't out for glory, but there's something that, I'm very passionate about. And one it is, and it's something that Ryan and I share in common. And that is, that we all should be able to live our the best lives for ourselves, right. And be free and feel free. And our finances are a big component of that. And on the flip side, for me, I know that, one of the ways that we can accomplish that, especially given the way that the public markets have gone in the last 20 or 30 years, where they are extremely efficient, it's very difficult to generate alpha, which alpha is sort of just, return above sort of the expected risk, right? Like it's hard to do. It's hard to generate returns, obviously extremely volatile. There's lots of good things about it, but it's difficult. And so alternative investments, those that aren't correlated, real estate in particular, is a great way to generate, have the potential to generate above average risk adjusted returns. And so, but with that said, it's most of the opportunities exist in a highly unregulated environment, as much as many of the people I work with daily, gripe about how much regulation there is. It could be far, far, far worse. There really is. It's very self-policing. And so at Verivest, we're all about really trying to take that off the table. The bad guys don't get a play, and they don't get to freely, move about and misappropriate people's money and misrepresent themselves is really what we're about. But I do that to the end of so that people can actually allocate capital, understand the risks that are inherent, going in eyes wide open. And this is the podcast, right? Is for us to sort of dig into that and understand what kind of risks are there so that we can make good quality investment decisions. Now, with all that said, it really isn't, it can be complicated. It's difficult. There's a lot of moving parts. It's easy for me to say I've spent every single day of my life since, January 1st, 2008 doing this. And so, on that date, I was as clueless as the next guy. On this date, I know more than I probably wish I did know. But there are other resources out there, and there's sort of a new burgeoning group of people who are, out there that are willing to help consult and guide individuals and families to the end of, how do you build a modern day investment portfolio, right? Much like, many of you have probably read about the Yale endowment model, and how they've, done a great job over there over the years, really without a traditional sort of 60-40 portfolio. It was very, very heavy and continues to be, and copied by many, even institutional investors in alternative types of investments, right? And so Ryan is at the forefront of that. What he's building there and what he does for his members at Mile Marker Club is really to educate and to help plan and help them construct those portfolios so that it's the portfolio is doing all the jobs it should be doing and providing its beneficiaries what they need when they need it. So Ryan and I were really talking about how it does take a community effort. So there's this community undercurrent. And so we've been attracting investors to veravest.com. They're intrigued. They see all these sponsors, they see all these opportunities, but invariably the question becomes, what should I invest in? Right. And that's the one thing that we do not speak to at Veravest. It's sort of I can tell you that they're good guys and, have their nose clean and that, all the money's going where it should go. But it's a bigger question. It's a good question. So, but Ryan has built relationships with people, and it really, we've hit on this in other episodes as well. Ryan is always sort of striking that, but the answer is it depends. It depends. And it does require an understanding of what you as an individual or your family are trying to get out of it. And you cannot remove the relational aspect and that community aspect. So Ryan, maybe you can speak a little bit to that. We've had a few people come out of the Veravest community that have reached out in the last, week or two. It's really interesting to see just that unmet need in the market and to see how people are really, really excited to hear what you guys are up to.
Well, that's a great introduction. And really, I think, Lance, where we're at today in the marketplace is a great understanding and a great recap of really how high net worth investors are feeling, or really successful individuals, entrepreneurs, and high net worth families. I can just, only speak to the types of investors who we serve, who are really, not really, they're already successful, Lance. They've already built their wealth. And you get to a point in time, whatever that level of wealth is, that you go, I can't lose it. And, usually that gets equated to when I'm in quote unquote retirement, more so what I like to call refirement. Those that we serve, they're always doing something else. They're not just sitting back on their laurels, which I think is one of the key ingredients that keeps a successful investor a long-term successful investor. They never stop learning. They never stop engaging. They never stop asking questions. They never stop wondering what is different or what it's not. They don't just stop, I guess, is the point. And that's what I love so much about what you've done and are doing with Veravest, both on your website with showing and showcasing those deal sponsors and your different levels, your verified gold, for example, and then what you're doing with your Veravest community. Because if you go back in time, this is always funny every time I think about this, before the internet, doesn't that make us start to sound like we're aging ourselves, Lance, a little bit? But yeah, the internet is not that old of a thing.
No.
And so from maybe like 2000 to 2005, when the internet was just first introducing itself, it's changed the way knowledge has been shared. It's changed the way information has been shared. And, in the early stages of the internet, and then as it progressed kind of in the last decade from 2010 to 2015, or when the Jobs Act came out anyway, we were all saying, wow, this is great. We're getting more information. It broke down barriers to knowledge. And then when the Jobs Act came out and made all of these real estate deals and so many of these alternative investments so much more accessible, we'll say to the high net worth individual, at least the accredited investor or the qualified purchaser, qualified client level, is that then it started to become overwhelming. There's now so much knowledge and so much information and so many new deal sponsors, so many different types of creative real estate investments for any investor to invest in, that all of a sudden, this vast amount of information that the internet's allowing for, we now need communities that truly still foster back to personal one-on-one relationships. We all thought when the internet came out, we're not going to conferences anymore. We can just ask the internet anything and we're going to get our answer. And what originally thought was going to decomplicate our financial worlds has all of a sudden just expanded it to a whole new level of complication, regardless of the size of our wealth. And I think that's where getting back to, and I think a lot of high net worth investors, as you mentioned in your Verivest community, since you've launched that, we're seeing those types of already really successful investors going, but wait a minute, I see all these deals. How do I know what makes sense for me? And that's where back to understanding your holistic strategy and your holistic wealth planning is all of a sudden taken on a whole new meaning that is not been fully contemplated or fully appreciated to this point as we're seeing it now, especially given the dramatically changing social, economic, and political environments that we find ourselves in.
Yeah, that's right. And I think, I had a feeling that's what would happen when we did what we did. I mean, I didn't want to be exclusive because in my opinion, there are many solid sponsors who are offering at any given moment in time, many solid investment opportunities that have up and down the risk continuum, duration, return profile, right? You name it. Like, I mean, of course I knew that was the case, but that meant we wanted to be more inclusive. But I knew the piece that we didn't want to fill, and really in large part because it actually, the second we would try to fill it, it would force us to be exclusive, was the investment advisory side, just anything that was sort of passing any kind of judgment or any analytics at the, I'll call it investment due diligence, the IDD rather than the ODD, which ODD is more of like your sponsor operational due diligence. Who are these people? Are these things in place? Internal controls? Do they, those sorts of things? Those are things that we can do at Verivest. Speaking to the merits or the risk and all those sort of things of any given investment is difficult. But like you said, it's gone the other way. Before the internet, you remember at the country club, and there's a couple guys who are deal sponsors in the club, and they offered those deals to other guys in the club, and those are deals you did, and they probably worked out, and you all made a bunch of money together, right? But once again, if you weren't in that club, you never knew about those, and the access was limited, and now we have just, it's overload. There's so many things out there that and we're seeing that now, because I think as we speak today, we probably have like 55, opportunities that are open in the, by sponsor members in the directory. So, but all that to say, of course, I've known you for years, and I knew what you were doing and what your vision was. And once again, and I know that when you and I speak, what you do is very intimate. It is very personal. That means that, you can't serve everybody, right? And not everyone's a good fit for you guys. And my hope is, as we move forward, just more and more people like yourself sprout up that look at the world the same way, that can help people, right? And I think that's why we call it, some people get confused when we call it, like I call it an ecosystem, but that is what exists. The ecosystem exists whether you can see the ecosystem or not, right? And so it's that's really what we're doing. But I think it's important, especially for you all as passive investors, just to realize that your situation is unique, and it does require, you have to be thoughtful, and you have to know what your goals are, and you have to know what you want to do, and those sorts of things. And I know for me, I mean, I have a coach, I meet with him once a week, right? And every week he's got to sort of like pull it out of me, right? Like, I know, but what do you want, Lance? Like, what do you want for yourself? Because, for me, I'm just like, I sometimes forget about myself. And it's the same thing what you guys do. You're like you're the coach or the CFO of the family, right? So maybe you can speak a little to that. I know we've hit on it before, but it's just, we can't touch it enough for people to realize that there's a whole thing you have to do before you should be jumping in and just allocating money willy-nilly.
Yeah, it's a great point, Lance. And it was something you said now a couple of times since we started this recording, was about the idea of an efficient market. And, if you're we're an economics major, a mathematics major, or something financial related in college or something, you always know about the efficient markets and those types of things. And, that usually, for most people anyway, draws their attention to the traditional publicly traded markets, stocks, bonds that are efficient. I believe they are. And what you mentioned just a moment ago, though, back in the day, especially before the Jobs Act here, private real estate deals, whatever they were all done, at the country club, so to speak, and something similar to that, meaning it was a very closed network, which is kind of the anti-definition of an efficient market. An efficient market works when the masses know about all the knowledge and the data, and everyone can freely make their own decisions. Well, efficiency has found its way to the real estate market and really a lot of alternative investing space today. Internet, Jobs Act, and so many other things, ecosystems that have been there, that have developed and have refined. And that's a good thing. That really is a good thing, to be able to allow all investors to go make their choices and have as much access to the information to make the best choice as possible. And so we as successful investors, as successful entrepreneurs, those that you serve, Lance, in your community, be it your fund managers that you and your team serve, the private investors that we serve at Mile Marker Club, what you have to get to realizing it's an efficient market. If you believe that, and of course, obviously I do, and I know you and I share that same belief too, is that you have to then realize how you make it work is then dependent on what you want. Like your coach is saying to you, is certainly what my coaches say to me. My own team reminds me of this on a fairly regular basis. Ryan, what is it that you want? What is it that you want to do? Who is it that you want to serve? Who is it that you want to be the hero to? Who is it that you want to make a big impact on? Yeah. And we as investors, though, especially if we've already made our wealth and we've got, X millions of dollars or tens of millions, whatever the number is, you have to go, what do you want that to do for you? And that becomes the basis that serves as the foundation of how you start to go and invest. Because frankly, Lance, a lot of investors have become successful in the last decade, because both in traditional investing, alternative investing, especially real estate as part of the alternative ecosystem, has done really well for more than a decade now. And so it lulls us into a false sense of security that we're doing the right things when a market can change on us on a dime. And you've got to be able to really ascertain from a risk standpoint, how much can the market change that will stop me from sleeping peacefully at night? And it's kind of a something I say to our, particularly new clients that, we're talking to try to determine if it's a good fit, is I use this analogy. Look, we're your sleep aid, and that's what you kind of defined in part what the role of a CFO does for a business, or in our case, serving as a personal CFO for the families that we serve and the individuals and entrepreneurs that we serve, Lance, is we're here to be your sleep aid, but you have to define the parameters of what sleeping is and what sleeping peacefully is. And I think it's a great analogy, because while we sit and help to try to keep within the guardrails, so to speak, is being able to identify first and foremost, what do you want and what are those guardrails? Because if you don't define what those are, and that goes even beyond investing, Lance, that there's a lot of implications to what as I say, guardrails. But if you're not clear on what your purpose is, you're not clear on what your desires are, you're not clear on what your values and goals are, you're gonna struggle as the massive markets begin to shift. And if you're not positioned and ready to be able to to know how to work within a shifting environment.
Yeah, I agree. And I think it's what you see, and you and I have talked about this a lot, is just that if you analyze most people's portfolios who are, have been quite bullish on alts and real estate in particular, more often, more than likely they're not balanced well. They're going to be overweighted, because what you see is some people is like they learn about debt funds and they think debt funds are the greatest things to slice bread, and they just put a ton of money in debt funds, or a ton of money into one debt fund. And I don't know, maybe that's okay, but the issue is that there's usually going to be some concentration, that it's going to geographic, obviously certain loan types, right? So those are once again, it's not that it's bad, it's just understanding that that's the power of diversification. Or many people have just gone wild with multifamily syndications. So it's just a multifamily syndication is the greatest thing in the world. I just can't get enough multifamily syndications. Well, what about like an industrial deal? I don't know industrial. I just do multifamily. And it's like, okay, I get it, right? But like, I understand it can be maybe a little bit more complicated. I know it's different. Okay, that's what it is. It's different. You haven't yet learned it, but it's just, once again, it goes back to what are you after? Like, okay, you can go and invest into an industrial deal that has, credit quality, triple net tenants that you can get in, and this lease is expiring and all the market rates. Like there's keep your mind open, right? To understand that, and not to mention duration. That's another thing you always bring up. It's just like, real estate is inherently illiquid. Therefore, you have to be very mindful of the fact of like, what deals are you getting into, and is the cash going to be available when you actually need it, right? Because what happens right now, and of course it is part of our vision, is to help create more liquidity, and make it easier to trade these things without taking a gigantic haircut. But as we sit here today, if you're a limited partner in a multifamily syndication and you need to get out of it, if you get 60, 65, 70 cents in the dollar, you're doing really good, right? And you probably won't even get that. So it's just, as much as I'm bullish on real estate, and I know you are too, Ryan, it's just, and I know you've seen this over and over again, even with your investors, when you've got funds with a redemption right, it's like, you're the type of guy that's like, yeah, you got a redemption right, but make no mistake about it. This isn't equivalent to, just selling stock, right?
That is such a huge point when we think about the world of alts and real estate, because again, the market does interesting things to us, Lance. Anything that lasts for an exceptionally long time creates a sensation of being normal. And I hate to use that word normal, given the, condition and all some of the conjecture around that word these days, but it's part of how the human psyche works, and the things that go on the longest, you just assume that's how it always is and how it always will be. And that is always not true. And so this long run that we've had of great real estate, what we can tell very often when we're looking in trying to help a family or an investor, an entrepreneur, just understand risk and define it for themselves, Lance, because we all know what risk means. We all know what the Webster definition is, so to speak, but the reality it's different for every one of us, how we look at it, how we manage it, how we quantify it, how we even think about it, which is part of the reason I love you hosting a whole podcast about risk, because sometimes it doesn't have a sizzle. The word doesn't have a sizzle to it. And so the fact that you're hitting it head on is one of the reasons so much of what I love of what you're doing. And when it comes to real estate and alternatives, part of the reason you should be getting a higher rate of return, or at least a higher expected rate of return, is to compensate you for the lack of liquidity. Yeah. If you compare it to a stock or a bond or a mutual fund that, is a public, readily tradable market to go create liquidity in. And I think that's a big thing that we've seen with investors, although by the time they start to raise their hand to want to maybe come work with us, they start to realize, well, wait a minute, I need liquidity down the road. I need cash down the road, or at least need to have the option for it. And so how you create your portfolio is going to be driven by that type of a risk parameter. And so it's a great thing that you're bringing up about an efficiency of the market, and the real estate markets, at least within the investor space, has become efficient, but it is still not liquid. Now, it's not that you can, if you own a rent property, go list it on the market, but it's not an efficient liquidation process. And how you need to manage that when you need cash into your portfolio to match your liabilities of your portfolio, meaning demands on your cash flow. That requires a lot more planning and calculating today than what we really ever had to do in the past.
Yeah, and that's what you guys, and that's what I like what you're doing at Mile Marker Club, is digging down below that, because that is the benefit of single family homes that have a value below the jumbo loan rate, is that would be really the most liquid of the real estate assets, meaning there's the number of people who you could transact and trade is the greatest number. It could be financed readily, whatever, right? So that's why, you should have some sort of single family exposure of that type, right, in the portfolio. But that is where, like, you have to understand, you go into multifamily syndication, it's not as liquid. Now, certain places trade more frequently than others. You can offload a multifamily property, but if something goes sideways, it usually means the answer is, let's just hang out and wait for the next cycle, right? Which means illiquid. And there's certain other properties, industrial or hotels or whatever. And, just the bigger the asset, the less liquid it becomes. So it's not that one is great and one's no good or none of that. But it's about when you go and you now have this portfolio and you've got exposure to that, don't fall in love with multifamily at the exclusion of anything that has some exposure to single family or whatever. I just think that's what you guys do, is you sort of say, time out. Let's look at, or the guy who's like, funds are the devil, or the guy who's like, individual deals are the devil, or whatever. Like anything thought process where you think that way, you're usually probably going the wrong direction, right? Like, it's not that simple.
It's not anymore. And again, back to what we started talking about here, there's so much more knowledge, there's so much more information. And part of us, when we all started to get our alternative investing and real estate investing sea legs kind of pulled together here, Lance, that's what we were all taught. Go with one thing, only invest in what you know. And there's still fundamental truths to that. But if the higher the net worth you go and the bigger your portfolio is, the more it requires the diversification, especially if you are heavily into alts or heavily into real estate. And it's not you can be. You and I are. Real estate is our thing. A lot of people listening to this podcast right now, real estate is their thing. You can be all into that. And it works until it doesn't work anymore. And I think that's what, I see even when we look at your website, Lance, that, go to veravest.com and we see the spread of what we call real estate strategies.
Yeah.
And you're talking about whether it's multifamily, whether it's a fund that does single family rentals, whether it's a fund that's doing vacation rentals, whether it's a fund doing mobile home and land, and some of these other, really fascinating real estate strategies that weren't a thing 15 years ago. Vacation rentals as an example is one of them. I'm not saying you should or shouldn't invest in vacation rentals, but it's a great example. That wasn't even a thing. No. And if you 15 years ago, well, not barely 10 years ago, and now to see sophisticated, efficient funds around any of these strategies come along, you start to look at that and go, well, wait a minute. Because of the efficiency, it can also be efficient to embrace those into my portfolio to create the necessary risk management that we need if you're going to have a real estate focus or a heavy real estate or a heavy alternative focus. And that ability is there today, but then you start to get into the nuances like those things you've mentioned, Lance, duration, understanding these are private investments. They are not liquid. Don't be fooled by a lockup period or a redemption period or get your money back in 30 days. That's all a function of how much cash does the deal sponsor have at any one time and what's going on in the marketplace. It's not a bank. And, that's part of understanding risk in an alt portfolio and realizing that you probably need to be managing how you think about your cash, especially given some of these market conditions we're in today, is a lot different than certainly what it was a year and a half ago, and especially than the 3 and the 5 years as we were on this big ramp up of this, long run real estate market that we've been experiencing now.
Yeah, totally agree. So for you guys in the club these days, what is sort of that theme? Is there a theme that's sort of been emerging, or just the collective sort of, what's sort of the topic du jour right now? What are people seeming to kind of be discussing?
Yeah, it's a great question, because it's really a big it's really a big deal of understanding, Lance, of I think where the market is. And look, I have the privilege of working with highly successful entrepreneurs, highly successful high net worth families, highly successful individuals with their wealth. And what I think part of the biggest thing is really how they're redefining what their wealth of the future is going to look at. Because if I ask a lot of our clients right now, 10 years ago, or maybe let's go back to the '08 real estate market, kind of what restarted this now current cycle that we're in, they wouldn't have said 12, 13 years ago that they would be as well off as they are today. They wouldn't have said that. They hardly would have predicted it. They knew they were going to be successful, just not to the level of success that they feel like they are today. And so I think that theme that we really see emerging, Lance, is one of wealth preservation.
Yeah.
And, sometimes some people hear the word preservation or protection and they start to think about, oh my gosh, a scarcity mindset. I got to rein everything in. I got to hold, it's rainy day, hunker down. That's not what I'm talking about. And the families that we work with know the difference between that scarcity mindset and that abundance mindset. But when I say really it's about the wealth preservation today, it's realizing that anybody or I'm talking about wealth today, whether it's a fund manager, it's your accountant, it's your CPA, it's your financial advisor, it's whoever it is, everyone's going to have a different variation on what it is. But realizing that the wealthy that we work with know it's about keeping it today. Yeah. It's you've got to hold on to it, and you're going to have to reposition yourself in a way that you've never had to before. So I think that's one of the biggest themes that we're seeing, and we're seeing even, it's hard as investors, Lance, when you're sitting on cash, your IRA, outside of your IRA, whatever, and you're like, this money needs to be invested. And I have that issue too. It's like, I got to invest it, but you've got to make sure you're investing it in the right things. And I'm seeing more and more of that trend of realizing, wait a minute, the go-go days of 3 years ago, 5 years ago may not be here right now. So instead of invest, I've got to plan.
Yeah, no, that's super interesting. Because when you think about like all the deal sponsors I talk to, all they talk about is like, how high a return do I have to hit in order for people to be interested? And it's funny because that mindset goes completely counter to what you just said, which is what I tell them all the time. I'm like, you have to understand that when you're a LP, limited partner with no control, you inherently focus on your downside risk. Like, just think about it. If it was your money, you're thinking about downside protection. You're the GP. You're the one who's thinking about upside. And because, you're not the world's most gifted sales guy, you can't overcome any objection that sounds like they care about the highest return. Now, with that said, I get it. The shiny numbers, definitely will attract people. But the point is that it can be overcome if you ask the right questions, which you've always been gifted at as a fundraiser. Once again, is diving in and thinking about them, helping them understand what are they trying to accomplish. You're going to quickly be able to get them off of that sort of, shiny big number thing, because that's fundamentally deep down, that's kind of how they're thinking. Like, I worked really hard for this money. Like, I just want to make sure I don't lose it. Like, so like, it's not too far beneath the surface to sort of push them to get there. They're thinking about, I want base hits. I'm not, I get it. People in their 30s and 40s, they're probably looking for doubles and triples, a home run every now and then. Right. But yeah, like you said, when you've worked hard and you've accumulated some wealth, you're like, I'll take singles. Maybe you get a double every now and then, sack flies, whatever it takes. Move, just get them around the bases. It's good enough, right?
And, that's part of the beauty of it, Lance, what you're really doing today. And this may be just another viewpoint on your question. Make no mistake, it is about wealth preservation and not losing it. But it's, as you just talked about, that running the bases analogy, you got to get enough of the right opportunities and minimize mistakes and minimize, making too many, mistakes in the portfolio and in decisions. And I think that's where a lot of the families that we serve today are further realizing they know what they know. Back to your point earlier, if you were just a multifamily guy, or you were just a note gal, or you were just whatever you were, you realize I got to be broader to diversify. And now it's about, we don't know what we don't know, and we need some help identifying those different things, whether it's about the investments, it's about the tax perspective, it's about our charitable desires that we have, it's about our legacy desires that we have, and those types of things. And I think that there's a lot of realization that it's getting more complicated, and you need to be very mindful of who's on your team helping you with all of that, so that you can truly preserve that wealth to the level that you want and have the greatest shot of doing so.
Yeah, makes a lot of sense. Cool. Well, as always, it's great to catch up. So where can people, if they're interested in sort of, picking your brain, or, maybe joining the club, or where can people find you, Ryan?
Sure, Lance. They reach out to us at our website, milemarkerclub.com, I think is a great place to start. We're in your Verivest community portal as well. So for those of your listeners that are part of that forum in that community, you can find me out there just under Ryan Parson there. So in either of those two ways are probably the best and the easiest.
Awesome. Very good. All right, man. Well, you have a great day. Thank you so much for your time. It's always appreciated.
Likewise, Lance. Thanks for having me back.